You know, the pattern of a forecast hasn't really changed that much from the last 12 months. What it means to rentals, of course, here we are going out on a limb again, but you know, our rent growth numbers are quite strong next year, with an average over these 3-year recovery years, which are quite an important period, 2010 to 2012, an average of about 6.7% growth in net rents. Turning to the investment market, we see quite a different picture. I mean, the values have now stabilised, yield is balanced. We see a very strong buy-side interest, as we'll give you again some evidence of that in a moment, especially still from offshore and, as Nick said, for Europe, for prime stock. The sell-side interest is a little more restrained, and I think this is really what's happening around the world as well. As owners have got through the toughest period, the big question is, why would you sell now? So you've got this imbalance merging between demand and supply, and that puts a bit of a platform under pricing, as indeed seems to be driving pricing in Europe as well. I guess the income growth promise in Australia is the big motivator. And it's one thing that stands out around the world, this ability to get into a position so soon after a downturn to actually to see rents grow. At least those conditions we know will be there. So the big promise is really the income growth side. We see a gradual return to bank lending. We think it's on the investment side still a market going to be dominated by equity, with a very cautious sort of letting off of the screws from the banks over the next few years. So a very gradual change on the lending side. And lending, of course, is a great motivator of pricing. So without a lot of lending, pricing direction is unlikely to be quick. It's likely to be very gradual in nature over the next few years. I guess the sales volume, like the rest of the world in the CBD, is still well below long-term averages. We know the interest is there. We know there are plenty of negotiations going on various properties, but still well below the long-term averages of turnover in the Sydney CBD market. Yeah, we wanted to try and get behind that, though, and understand the demand for stock from investors in Sydney and indeed around Australia. So we did this analysis looking at the number of bidders for properties that we've had on the market in the last couple of years around Australia. And you can see that it's anywhere between 1 to 8 bidders for single properties. So it does show you that there's a fair measure of demand in behind the activity that is happening, albeit it's still at a relatively lower level. And the other interesting point too is the dominance of overseas interest. In virtually every one of those properties that we've handled, there's been a bidder from overseas. So what it means, bringing that together for the CBD, is that the capital value increases that we do forecast, you'll see on this chart, are really driven by the income side. And the yield change there, you'll see, is quite gradual. And I think that's a feature of all our forecasts, that the yield trend, the compression, is going to be quite mild. And you can see the numbers there, an average of about 10% growth in capital values over the next 3 years. So that's really one of the strongest forecasts we have around Australia. It's right here in the Sydney CBD market. Of course, some investors might be unable to get into the Sydney market, into the CBD. The suburban option is always there, and I guess it offers a high yield and a lot of variety across the various sub-markets. We've seen the suburban market overall perform better than the CBD. It hasn't gone into contraction of occupied space. It's kept on expanding, even in the midst of the global financial crisis. You see that on this chart, and we forecast the net absorption to bottom out this year before picking up a little next year. And the other feature of the suburban markets, when you look at them overall, is that they're very closely matched between the supply of space and the demand for it. Very, very closely matched. So it's a very stable environment, and the vacancy rates there too, a bit like the CBD, are set to sort of come gradually down over the next couple of years. So don't write off the suburban markets, we say. There's a lot of different opportunities there, a lot of variety in behind these sort of charts to have a look at. In fact, that's what this chart shows you, the levels currently of yield, and the way that yield has stepped back again from the CBD. So you've got a lot of variety as yield goes to the higher levels, anything above sort of 8% in certain suburban locations. So our forecast for the suburban markets overall is for sort of much lower growth, much steadier growth, about 5% growth in capital values over the next 2 or 3 years. It's a much steadier market, one where by nature rents don't grow dramatically. They don't have those spikes that the CBD offers. So we see a much more stable outlook for the suburban markets overall, but a lot of variety, I stress, to look in behind in the different sub-locations. Let's turn our mind to the industrial sector, one that was hit quite hard by the downturn. We do note that demand for industrial space is now returning. It's being driven especially by the bigger retailers, the Kmarts, the Targets, the Coles, demanding greater, larger warehouses. We think the pre-commitments are certainly starting to happen, and some of them are very, very large. We notice that the imports are starting to come back into the country, a key sign that there's going to be more demand for warehousing. So the Port of Botany is busy, and its expansion will come online just in time for the increase in imports coming in through the country. Incentives in the industrial market are typically not a feature of this area, but they have increased over the last couple of years and are now also starting to fall as the confidence improves. From an investment point of view, I think Nick's story about prime and secondary is very much the case in the industrial market, with a much stronger demand for grade A stock in what is still a very, very tightly held market. Yields have moved out further in industrial, so we think they do provide a little more opportunity for some compression, as we'll show you in a moment. The construction sector in industrial fell away rapidly as confidence and development finance disappeared over the last couple of years. We think it'll bottom out this year, and we're already recording an increase in industrial construction activity in 2011. We've got a development pipeline of over 3 million square metres, waiting to come online. So while the construction activity is still below average, we do think it'll step up and double in 2011. Here are just a couple of examples of sort of the activity that is underway. A 36,000 square metre warehouse has been committed to by Best & Less, a discount retailer out in Eastern Creek, is set to complete next year. An 18,000 or 19,000 square metre shed out at Greystanes to Solaris, a recycling company, recently completed. So these are just two examples of the sort of demand that's coming straight back to where it was in the outer western areas of Sydney. So on the rental side in industrial, we really never see a lot of growth, and we never see a great downturn either. It's a very stable market. We did record about a 3-4% drop last year, and our forecast call for back to pretty much the CPI style growth we typically find in the industrial market over the next 2 to 3 years. And that really sort of shows you there the result of that forecast, about a 7% increase in capital values over the next 3 years in average grade A warehouse capital values across metropolitan Sydney. So it's sort of somewhere in between suburban office, if you like, and the CBD market. I guess one of the big legacies of the downturn has been a drop in industrial land values. We've seen land prices around Australia fall from anywhere between 25 to 50%, depending on location. So we're pleased to report that those values are now stable. We're starting to see deals done at these kind of rates that we see up on the screen. So we think the worst has been witnessed in the industrial land sector as well. The final section we want to cover this morning is Sydney retail. I think retail really is quite different. We're looking at some pretty good, strong recovery straight into 2011 from office and industrial, but retail we're really pushing back another year. And it's been a sector where consumer confidence is now quite low. Spending has been very flat this year. It's somewhat counterintuitive after 2010 is meant to be a recovery year, but coming off the back of very low interest rates and the stimulus packages that came through from the federal government were so successful that coming back off that, the consumers I think are worn out, and it's a very flat environment. Against that, I mean, population employment growth has been quite strong. It's kept on growing. Housing construction doesn't seem to be able to catch up to population growth, and that's a real issue for New South Wales. So the great opportunity for retailers in population growth is not feeding through because of the lack of housing construction. Retailer demand we've found has been quite resilient, and the strong and the weak have diverged. Strong retailers are picking up great sites and picking up other retailers, but the weak are really falling by the wayside, as we'll show you in a moment. So really, I mean, for the outlook for retail is quite different. We're really pushing back the prospects of growth in the retail sector, not from this year, but really back out into 2011.